Today is 7th of May 2019 and the Reserve Bank has just made a decision here in Australia to keep the interest rates at the historically low 1.5%, the cash rate. Make of it what you will as far as how that's going to influence the Australian economy and the housing. However, I've got more news for you to share.
There's been another indicator of economic weakness, with building approvals slumping. New South Wales and Victoria experienced the biggest falls, mirroring their leading role in the national property price slide. Total approvals fell 15.5% in March, according to ABS figures. It's a volatile series, but the trend is undoubtedly downwards, with approvals now 27% lower over the year. Apartment approvals are down 56% from their all-time high in 2017, something the RBA will no doubt be watching as it considers whether to cut the cash rate. To the markets, and that building data put further pressure on the Aussie dollar. It's buying just below 70 US cents. And on the share market, the All Ordinaries and the ASX 200 finished virtually flat, losing just a few points.
Okay, so apartment approvals are down 56% from their all-time high, and the Australian dollar's dipped below 70 cents to American dollar. You can imagine that the unchanged rate decision, as opposed to a decision to cut, is going to push the Australian dollar even lower. But that's not all, there's more. A quick disclaimer that this news was just before the rate announcement that happened about half an hour ago. So they'll be mentioning whether the interest rates are going up or not. We now know, down or not, was the debate. So we now know that the Reserve Bank's left it at 1.5%.
A profit slump wraps up reporting season. Westpac refuses to commit to passing on the full RBA rate cut.
Now the next segment is focusing on the less profitable banks and the new normal. They'll try and blame it to all the remediation costs that came out of the Royal Commission. I don't buy it for any moment. The remediation costs are high, however, they are a drop in the bucket if you ask me. So the elephant in the room for this video is the fact that the housing is not doing well, and the home loans and the mortgages, there's fewer of them being taken out, and the amounts are lesser, and there's more competition. So banks are stuck pretty much. So they're stuck between a rock and a hard place, but I don't feel sorry for them because of the fact that's coming up.
Westpac has capped off the big bank reporting season with a 24% fall in half-year earnings. As with the other big banks, costs of fixing the bad behaviour revealed at last year's Royal Commission are having a big impact, while a slowing housing market also is not helping. Despite the headwinds, Westpac still managed a profit of $3.2 billion. Andrew Robertson filed this report.
With earnings down by a quarter, there was only one thing for Westpac boss Brian Hartzer to do, and that's be honest.
This is a disappointing result.
Half-year profits slumped a massive 24% to $3.2 billion, although Westpac is maintaining its dividend at 94 cents a share. There's the mounting bill for last year's Banking Royal Commission. And for Westpac this half, it was $617 million in payments to customers and other costs. Add $136 million for reinventing its loss-making wealth management business, and the hit to shareholders was $750 million.
In my opinion, these so-called remediation costs will be blown out of the proportion. They're telling us they are $753 million for Westpac, for example, but I think if I was an accountant within Westpac, I would be trying to shift all sorts of costs that I possibly could on the bottom line, on the balance sheet, from other areas into this remediation and say, well, poor us banks, we had to comply with all these new rules that the Royal Commission has put upon us, so this is the cost. I bet you a bottom dollar that this is the case, but I don't know that. This is just a speculation, obviously. I don't have any additional or extra information than what's already out there in public.
The remediation provisions reflect a number of areas where we made mistakes and didn't meet our standards or documentation requirements.
This is a bit laughable, I have to say. I mean, we made mistakes. I mean, $753 million worth of mistakes. In any case, the cost of remediation cleanup, I just don't buy it. You know, I'm a skeptic. I've been thinking about renaming this channel from Economy Times, which is kind of a dumb title that I came up a few years ago, to Skeptic Economics or something like that. Let me know if you got any ideas.
It shouldn't have happened. We need to do better, and we will.
And the property slump is biting. Mortgage growth fell by 2/3 with no growth in investor loans, and like the other banks, there was a spike in people missing payments. Against that backdrop, Morningstar's David Ellis says the dividend payout ratio at 98% is unsustainably high.
This next statement was a bit of a surprise to me, that the mortgage growth has dropped by 2/3. So does that mean that mortgage growth has dropped by 66% or so?
Mortgage growth fell by 2/3 with no growth in investor loans, and like the other banks, there was a spike in people missing payments.
This is one of the reasons why I think a Reserve Bank did not cut interest rates today as some expected. About 50-50 was between the economists and so-called experts. You tell me if you agree.
I understand the interest in this, and we certainly understand that interest rates are really important for customers, particularly who have loans. They're also important for customers who have deposits, and that's all I can say right now.
That was Westpac's CEO's response to a question whether they were going to pass on the interest rate cut in full. Should that happen? Pretty much he said, probably not, definitely not full. So why would the Reserve Bank cut the interest rate and kind of embarrass themselves and then have to chase it and say, well, they've lost control of interest rates. So they're better off just leaving it where it is and hoping that this train wreck does not get any worse. So they just left it the way it is. That's my personal opinion, obviously not financial advice. It never is. I have one more statement to debunk in my layman's terms, as always. This is it.
A key profitability measure for the banks is the net interest margin, the difference between what they borrow at, what they lend out at. It's down to 2% now. In the last couple of years, we've seen it up around 5-6%. Is this the new reality?
Yeah, I think it's incredibly challenging, and it's hard to see it getting back to those sort of numbers that you're talking about. It's quite interesting. There's often a lot of focus on the portion of...
Let's all shed a tear for the banks with the Ernst & Young, I believe, chief economist here.
Is this the new reality?
Yeah, I think it's incredibly challenging, and it's hard to see it getting back to those sort of...
It's challenging and hard to see those numbers with banks. But let me debunk that for you. If the net profit... Okay, so the net interest margin is the difference between what banks have to borrow on the money markets and what they lend out. So used to be apparently 5-6%. Now is about 2%. So let's call it just for the interest and simplicity of this analysis. So it used to be 4%. Now it's 2%. It's actually exactly the same. The 4% of profitability that used to happen on $500,000 is exactly the same amount of money, same amount of dollars, as its 2% profitability on $1 million. I hope I got my maths right, but that's exactly what's going on, which is why banks have exactly the same profitability right now, although their net interest margin apparently has halved in percentage terms, but in absolute terms, in dollar terms, is exactly the same.